Welcome to the Rose Show podcast. Thank you so much for joining us today. I have the honor of being here with Carley Garner. She's a senior commodities market strategist, an author of 4 to 5 books, if you consider the second edition of one of her books, and a contributor on TheStreet.com and Mad Money, Jim Cramer. We've seen her quite a bit, her charts being featured on Jim Cramer's show. Pretty impressive, Carley. So how you doing today?
Thank you. So far, so good.
Awesome.
But
How's that cute little beagle doing? We love seeing
oh,
pictures of him. Or
yeah, Frankie.
her.
That's okay. That's okay. She goes by anything. She's great. She's super happy. Most people don't get to fully experience beagles in their life, but I recommend it. They have a ton of energy. So if you have the time to make sure that they are walked and exercised properly, they are the best dogs. You can't beat it. Now, if you don't have time to exercise them, forget about it. You're dead meat. You don't want one because they get into trouble if they're not tired.
So cute. I used to have a dachshund, so just love that high energy, cute little small
Yeah.
dog.
Yes.
Loving dogs. Carley, you are a speaker on many events, that money show, big recently in Las Vegas. So you're a pro at this, and we're so excited to have you here today and talking commodities, futures, and options trading. But before we get started with all that, I'd like to know how you got started. Why commodities? How did you come to commodities?
Well, I wish I could say it was some sort of master plan, but it wasn't. It was kind of serendipitous, just kind of landed in it. In college, I changed my major several times. I ended up getting 2 degrees because I just was that uncertain about what I wanted to do. I thought I wanted to be a stockbroker, but when I got into it, it was a lot of like selling loaded mutual funds and things like that. And I'm not a very good salesman, and I didn't think I had anything to offer. It just wasn't my thing. And so I randomly run across an ad for a commodity brokerage here in Las Vegas, and I thought I'd give it a shot, and been doing it ever since. And I've actually loved, I'm not gonna say I've loved every minute of it, because this is it's a brutal business. I mean, the highs are euphoric, the lows are just like suicidal, but it's fun. It keeps me interested, and so I love what I do most of the time.
Love it. It sounds very exciting. And I mean, it takes a lot to handle all those ups and downs. And what we hear about commodities, that they're very volatile. So, and risk management is always key. So I'm excited to know about your strategies. I have to ask you, there's a lot of talk about the commodities super cycle. Do you think we're in or entering or leaving one, or what's going on with all that talk?
I guess it depends on how you define super cycle. We hear this a lot. My definition of super cycle is a bull market that lasts for a substantial amount of time. But the thing about commodities is bull markets generally don't last very long. If you look at a commodity chart, you can pick any of them. It could be gold, it could be natural gas, it could be crude oil. If you look at a really long time frame, you'll see that commodities aren't like stocks. They're not built to go up over time, mostly because they're not paying dividends. They're not producing income. They're not, growing earnings, things like that. That's just not how that market works. It's a feast or famine market. We have bull markets that last 6 months, maybe a year at the most, maybe if we're lucky, a year and a half. But they generally are. It's not a buy and hold type of situation. They rally really hard and really fast for short periods of time, and then they do the exact opposite, which is kind of what we're seeing in some of these markets. Anyone that's followed crude oil has probably, hopefully they're not trading it, or if they are trading it, they've managed to survive. I mean, we saw crude oil in the last handful of years go from, I'm going to say $20, even though a lot of people will say it went negative. It did go negative in the front month, but not very many people were trading that month. That was kind of a fake news fluke. But crude did decisively and significantly trade under $20. Let's say 15, and it went from there all the way up to $130 a barrel. And now we're looking at like the high 60s. And so if you can imagine, if you were lured into buying into oil above 100, or let's say even worse, 120, 130, which at the time last year when oil was at 120, 130, everybody was bullish. Everyone was talking about 150, 200, sky's the limit. And that's just how commodities are. They lure people in and then they kind of dash their hopes and dreams. And so it's a really treacherous market. So timing is very important. Timing is important in any market, but particularly in commodities. And as you mentioned before, risk management.
Absolutely. Wow. You walked us through that crude oil ups and downs. And absolutely, I agree with you. It can be very brutal, and how you're able to follow the seasonality and the sentiment and read all those signals, because I know you trade futures, correct?
Well, we're a brokerage shop, and so our clients trade futures and options on futures, and we assist them in that. I do trade a little on the side, but my bread and butter is the brokerage. And to be honest, I got beaten up so badly in crude oil last year. I'm on the sidelines. I'm clearing my head a little bit. So sometimes that's needed. It's been a really crazy couple of years in commodities. Some people look at a chart and they assume that it must have been a great year for everybody in commodities, but that's not necessarily true. I would say the majority of commodity participants in the last, let's say since 2020, March 2020, when all heck broke loose because of COVID, it's really just been one black swan after the other after the other. And so there's been some people that have probably made a lot of money here and there, but I would venture to say that most people have been on the wrong side of that, because we're talking about things you can't predict and volatility that's just historically unprecedented. And so there's a lot of weird things going on that probably shouldn't happen, but they happened. And all we can do is play the hand we're dealt.
Absolutely. And like you said, if you're on the wrong side of that trade, it can be
Yeah.
very, very treacherous. But yeah, like when gold ran a few months ago, it ran really hard. It was like up every day. And then silver, remember, it was like running pretty hard as well. But yeah, if you're on the opposite side, that is very challenging, to say the least.
It is, absolutely. And I should point out, commodities actually go down more than they go up. And so it makes it really difficult to be an uber bull at any particular time.
Absolutely. So then you would say it's more of a trading market than it would be considered an investing market, correct?
Yes, and I will also point out the commodity markets were like created and developed for risk management. They go all the way back to the farming, when the US was basically a farming economy. And so they're there for people to hedge their price risk. Like, for example, our brokerage has a lot of farmers and ranchers that are hedging their business risk. And you can do the same thing with your portfolio. So if you own, let's say, $250,000 worth of S&P stocks, or roughly that amount, you can use E-mini S&P futures or options to hedge that. So there are very valid hedging purposes for the commodity markets, but as you mentioned, most people are using them to speculate. And so it's definitely a trading market, not a throw some money in and check on it 6 months later kind of thing. No, absolutely not.
Absolutely. Thank you for pointing that out. A very important note there. You mentioned so many, you're like a wealth of information. And you mentioned crude. I want to talk about crude. And I also want to talk about ag and, corn. And I know you trade the grains, I believe. I've seen you speak about it as well. And recently you made an excellent point, and I just want to bring it up now while we're talking about what's occurring with the farmers. And I believe you said something along the lines that they didn't hedge themselves and they ended up selling because they were forced to sell. And so that's what's going on right now. Could you tell us more about that?
Yeah, so I'm just speaking based on my observations and
Yes.
conversations I've had with other people. I mean, it's not a scientific poll or anything, but unfortunately, I would venture to say that the majority of farmers don't hedge. Some are very diligent in hedging, some are not. I would say the majority of them are what we call cash market speculators, meaning they're just every year, they just hope for the best, and they're hoping for every once in a while, they get some really, really great output years. Prices are high and they do well, and they're just hoping for those things to happen often enough to keep them afloat. But the reality is, nobody knows what's going to happen next. Nobody can see the future. Prices are never guaranteed. So your best bet is to hedge at least partially. And so what's happened recently in the grains, if you look at a chart of wheat or corn or even soybeans, you can see that we've really come off the highs. I know everybody likes to talk about inflation and food inflation. And in the grocery store, that's true. But in the commodity markets, most of that inflation has not only unwound itself, but it's actually gone to deflationary territory. We're
Mm-hmm.
actually lower in most of those commodities than we were a few years ago. And a lot of it is people, people like us, we go on TV or we write about markets and we want to try to pretend there's some sort of fundamental story that explains the price action. But sometimes it doesn't make sense. Sometimes prices go to levels that you wouldn't assume to be possible because of positioning. People that are on the wrong side of it, and they're put in positions where they have to sell because they have to, not because they
Mm-hmm.
want to. And I think farmers put themselves in that position. They saw corn prices at $8, they saw wheat prices in the 13s. And so as the market started coming down, they couldn't get themselves to sell their product that they had in the bin or wherever it is that they were holding their corn because, I mean, a month ago they could get $8. They're not going to sell it for 7 now. And then it just keeps dribbling down and eventually get to a point where they they've got loans to pay, they have bills to pay, and they have to sell. And that's exactly what's happening, unfortunately. So you can see there's
Yes.
definitely some advantages to hedging your price risk
Mm-hmm.
because hopefully you could at least take a chunk out of that and take some of the pain out of your situation.
Absolutely. Excellent points there. I read a little bit about that as well. And, we see that similar phenomenon going on with just the markets overall. They talk about the college loan forbearance ending and, bills are coming due. So when bills come due, then people are going to have to find ways to have that liquidity to pay their bills.
Mhm.
And they're going to be forced selling maybe in equity markets or wherever they're going to have to cut back. So it's the same phenomenon that we see in markets everywhere. So excellent points and great observation. Thank you for sharing that. With that in mind, do you think that, markets are based on supply and demand? And when the selling's all done, I mean, usually I like to think that there could be the buyers are there. Could there be opportunity? Are you watching that for opportunity?
Absolutely. So we've actually started recommending that our clients position themselves on the long side of most commodities. Haven't quite put anything out in crude oil yet. I mean, we did a month or so ago and took profits on it. Now we're looking for another place to get back in. But I think across the board, commodities are starting to look attractive. But you want to be really, really careful because anytime you're trying to uh, pick some sort of a bottom and you're against the trend, you want to make sure you have room for error. So we're doing it with options, not futures. That way we don't have immediate price risk, or at least not substantial immediate price risk. But to your point, you're absolutely correct. Unfortunately, like markets are really mean. For lack of a better word, they're just mean. That what happens is when everybody runs out of money, when the margin calls all work themselves out, everybody gives up and they just can't take the pain anymore, is usually when the market bottoms out because we run out of sellers. It may not even be that buyers are stepping in. It might just be everyone that needed to sell sold and now there's no one else to sell. And so sometimes it's as simple as that.
Exactly right. Well said. Well, with that in mind, let's go right into your trading strategies and what you like to do, what your style is, your time frames, how you like to use options and futures. So please tell us all about that, Carley.
So I will say that I don't think there's an optimal strategy or time frame for all scenarios. I think you have to kind of look and see what the market's giving you and go from there. And also look at your analysis. Are you looking for a move that might take a year to happen, or maybe a couple of weeks? And so there's a lot of variables that need to be considered. That said, generally, like when we put out recommendations for our clients, we're usually looking for a couple things. The first thing I look at is market volatility. If volatility is low, options are usually cheap. And so maybe sometimes we just look for opportunities to just buy cheap options. If volatility is high enough, we might look to sell options to pay for the options that we're buying. Now, depending on how you structure that trade, there could be unlimited risk, so it's not for everybody. If you do decide to partake in some of these things that I'm mentioning, please do your homework because um, it can get ugly if you're not quick to hedge or take action if things go wrong, and things can and do go wrong. Even if you do everything right by the book, sometimes you're just in the wrong place at the wrong time. It happens, and you have to be prepared for that. But generally, a strategy that we really like in a market that has enough volatility to justify it is what we call a vertical spread with a naked option to pay for it. So for example, in a market like oil, like I said, I'm not recommending this now but maybe in the next couple of days, it's something we're shopping around for. We might look for options with 70 to 90 days. So we're talking maybe September, October. We'll have to kind of see how things go. And we'll look to buy a vertical call spread. So it might be like a $70 call, buy the $70 call, sell a 75 call, and then we'll look for a put to sell to pay for that spread. Because the thing is, options are priced to lose, and most of the time they expire worthless. Not always, but a lot they do. And so obviously, when you're selling a naked option, you're accepting a lot of risk, especially if something out of the ordinary happens. So you don't want to just do it casually. You want to make sure you fully understand what you're doing and you fully understand where your risk lies. So we'd probably put the strike price somewhere 60 or below, meaning we give ourselves about $8 to $10 in room for error to be wrong. And if we're right, that trade would pay out somewhere between 4,000 and 5,000, depending on what we pay for the spread. So those are the kind. Again, I'm not recommending this. I'm just giving you an idea of what we're looking at in those kinds of markets. I would never do that type of strategy in a market that's extended to the upside, because if you're wrong about the trend and it reverses, you're going to really get run over with your naked option. In a market that we simply don't trust, and we wouldn't sell an option, we might do something like just an outright vertical call spread or something like that. Or if we think, for example, in corn a month or two ago, we started to turn bullish a little early in corn, but we knew that maybe we're early. So we just started buying some December call options that were cheap to have as flyers, just in case something turned around before we thought it was ready to. And so we ended up experiencing drawdown on some of those long calls. But what we did is, once the market finally got under $5 in December corn, we decided that's a place to get a little more aggressive. And we did what we call a risk reversal. We sold a put and then used the money that we collected on that put to buy a call. And again, we're doing this to reduce our out-of-pocket expense, but there's margin and risk with it. It's not free. Nothing in life is free. So we do those sorts of things because we know that options are expensive, they're priced to lose, and so we behave accordingly. But at the same time, you have to be prepared to hedge that sort of thing. The nice thing about futures is there are a lot of ways to hedge. You just have to think outside of the box and be creative. So let's say, for example, with the trade I just mentioned a minute ago, selling a corn put and using the money we collect to buy a call option, we can do it as a free trade. If we're dead wrong and things just start moving against us, we could consider hedging the trade by maybe selling a mini future against it. The options they trade against the full size contract, but there's minis that are 1/5 the size of the full size. So you can actually get yourself pretty close to delta neutral while you see what's going to happen. So there's lots of possibilities. It can get kind of complicated. We, as humans, we tend to make it more complicated than it is, and sometimes we overthink things, and that's where we get into trouble. Instead of reacting, we think. But the strategies and the instruments and the tools are there. We just have to apply them efficiently, and sometimes it's easier said than done.
Absolutely. I love that creativity and thinking different. And that is key. And making delta practically neutral like that is just, it's beautiful. And, the key that you mentioned through your amazing example, thank you so much for giving us those strikes and those numbers, and vertical selling the put. I love that. I love getting those using that credit to help fund that vertical. Plus you're getting the credit on selling that as well. So you're minimizing your costs. Is that, risk management is always number one. And it's very important to note that, but it's being creative. And I love that. And that's what your books reference. And I want to go right into your books and talk about this creative option setups that you have. You have a way of simplifying this derivatives market. And I'm going to tell you, it's a very complex market, and and it's simple but not easy. And the way you just described it really simplifies being able to play the market with lowering your costs and minimizing your risk. I'd like you to just simplify the derivatives market. I know it's a complex market, but it just in just a few sentences, if you could just tell us, what does the derivatives market mean? Because a lot of people don't understand what that actually means. So if you could just tell us what that means to you.
Okay, so I'll use a futures contract as an example. So
Yes.
futures is a derivative, and what that means is that the value of that futures contract or the price that it's trading is derived from the value of the underlying assets. So let's talk about corn. So corn futures, the front month, I'll use the December contract because that's one I'm following the most. December is trading at like 510, and what that means is, if you bought that futures contract today, you're saying I would be willing to pay $5.10 a bushel for corn in December upon delivery, assuming that you held all the way to expiration and you actually wanted to take delivery of that corn. Nobody does that. Hardly anyone takes delivery, but that's what the contract is telling you. So that the futures price is basically derived from the expectations of the underlying commodity price. It's a lot simpler than what I just made it sound, but if you trade it a couple times, it actually starts to sink in. But it's one of those things that in a couple sentences, maybe can't do it justice.
Got it. No, you said it well. Thank you so much for explaining that. Right now, we're about almost June 1st. So how are you looking at, and we talked about oil briefly, with OPEC's cuts, and now they cut back their production. They're talking about their June 4th meeting that they're probably going to be there. People are saying they're going to be cutting back as well, or maybe in the near future. Do you think that short term you're going to see some type of bullish? Are you more bearish? Do you think it could double bottom and go back and stay down and maybe hit 63? I think it went down to 63. Do you think it's going to go there? I think it's in mid 60s right now. I'm not following closely, but then do you think it's going to top out about 90? I was looking at the charts and I think 90's resistance. You would know best. Like, how would you play that by looking at that with your creative way of playing the options?
Right. So your numbers are good. I do think that the market most likely finds a bottom somewhere in the mid 60s. That might be 63, might be 66, somewhere in that ballpark. The thing about oil is, we're always talking in generalities. It's an art, not a science. So you're never going to pick the exact high or exact low. But somewhere in that ballpark, I think, is a place to start considering employing bullish strategies. And the strategy that we will probably be employing is a vertical call spread with a short put, like I mentioned before. And simply because we actually were bearish oil when oil was above 100. We were bearish, and we were laughed at, and people made fun, like picked on us on Twitter and YouTube. But the reality is we're kind of in the opposite situation now. Everyone is bearish. Nobody believes crude oil can go up anymore for whatever reason. The narrative is flipped. And usually when everybody's thinking one thing, the market just generally does the exact opposite. Yeah. And I think we're in a situation where we're seeing that sort of thing. There's just too many bears. And the reality is OPEC has a lot more, like, they've gotten their mojo back. They have a lot more control today than they've had in the last several years. And we can debate why and how and where, but it really doesn't matter. The reality is they have the power to move the markets now, where they didn't maybe 4 or 5 years ago. So I think we're kind of at the mercy of OPEC. U.S. shale producers have already basically said they're not going to be putting a whole lot of money into developing new sources of oil and that sort of thing. So their investment dollars are down. They're still producing almost as much as they were in 2019. So we don't want to get confused and assume that they're producing less, because they're not. They're producing just as much as they are. They're just more efficient, and they've learned that it doesn't pay to flood the market. They did that once and they got burned. And OPEC is actually quite savvy. They know exactly what they're doing. In March of 2020, OPEC kind of declared a price war almost on each other, like Russia and Saudi Arabia were going at it, but they were also against the US shale producers. And what ended up happening is we flooded the market, COVID came, and it made it even worse. But the outcome of that is exactly what OPEC wanted. They wanted to basically teach everybody a lesson and teach them not to interfere with their business practices, and they did it. Now shale oil producers are in line with OPEC's game plan, and I think that OPEC's probably their plan is to do the same thing to the Biden administration. The Biden administration decided they wanted to tap into the SPR and artificially push oil prices down, and they succeeded, and that was great. But I have to wonder that if OPEC's going to retaliate a little bit. And I think that's probably what we can look forward to in the next 6 months. So I do think that these support levels will matter. All the bullish stories we've been talking about, the Chinese reopening, OPEC, all those sorts of things will actually matter in the low 60s.
Mhm.
And I think we get a rally. If you look at a weekly and monthly chart, you mentioned it already, 90 to 95 is probably doable. So that's where I think we're probably headed.
Very nice. Yeah, you're right. It's like I'm hearing everyone say, "Oh, it's not going to go back to the 90s. We're stuck in this range." They say 83, I think right around there. We're going to stay there. So we'll have to wait and see. So, Carley, what I did hear you say recently, and amazing, you give great interviews. But you said, "Don't fight the Fed and don't fight OPEC."
Right.
I like that. So yeah, you're like they've established their own selves out there, and you've been hearing a lot of people say how we're not going to see 90s again, but I think we'll have to wait and see what happens because that's
Yeah.
definitely a possibility.
Yeah,
So
time will tell.
time will
I,
tell.
I would like to point out when oil was at 130, nobody, and I mean nobody, thought we were going to see 70 again. So it's
Yeah.
just, you just have to be really careful buying into the narrative that when everyone jumps on board, it's usually the wrong idea.
Absolutely.
Yeah.
Commodities are definitely exciting and not for the
Yeah.
faint of heart.
No.
But what do you think about natural gas? What's been going on there? I know this is seasonality going from winter to summer now, but are you bullish on that one? I mean, it seems to have really gone much lower than most people ever thought it would.
Yeah. So natural gas is a real, they don't call it the widowmaker for nothing. I mean, it truly is a really tough market. People are attracted to it because it moves occasionally, and it can make people's life and it could ruin people's lives. That's just the type of market it is. Same thing with oil. When natural gas was at $10, I can guarantee you nobody thought it was going to 2. I was probably the most bearish person out there, and I thought 4 was the limit. So it's definitely well below 4. So it's exceeded my expectations on the downside, and I'm not necessarily happy about that, but it is what it is. I do think that natural gas will find its footing, and it will probably make a comeback. The problem with nat gas is the Freeport LNG terminal was it blew up or whatever, whatever caused that, and it's been out, and it should have come back online fully already, but it's just the process is really, really slow. There's a lot of red tape, and so in a nutshell, we're making more natural gas than we ever have in the US, but we have no way to export it. So it's all just kind of flooding our personal market, which is nice for consumers, but not so nice for anybody trying to play the long side in commodities. I do think that resolves itself. I mean, we're getting into the summer months where there's going to be a lot of consumption for air conditioning. And then after that, obviously, we have the winter coming up. So I would venture to say the nat gas is probably within 10 to 20 cents of a low, but we're not going to see the $8 to $10 stuff we saw the last couple of years. That's behind us. I mean, I would be really excited to see $4 to $5. So,
Wow.
but I think it is possible.
Oh, that's another one that could have trapped a lot of people when it was up really high the end of last year. And I think the beginning of this year or something. I even lost track of time, but yeah, when it was really high, I remember that. Boyle, I remember playing Boyle. But yeah, so now let's go to the metals. Okay. Now all this talk about gold. I mean, I played gold, MGC, I think it was, MGC and SIL futures not too long ago when they were running really hot. And all this stagflation talk. And when people talk stagflation, they go back to the 70s and 80s and they say, oh, we got to go gold and you got to go silver, or mainly gold. Do you think that gold will go 2100 or even higher? Does it look like that on the charts? And how's the sentiment? What are you noticing with gold and silver?
So here's my thought on gold and silver also. I'm not a gold bug by any means. I have definite, pessimism when it comes to like the true value of gold. What I can say, like a lot of people want to say gold is an inflation hedge, gold is this and that, a stock market hedge. In reality, it's really not good at any of those things, but what it is good at is it's a good diversifier for a portfolio because it tends to not be correlated to basically anything. It just does its own thing. And it's, again, like any other commodity, it's not a buy and hold market. Anyone that bought gold in 2011 just barely got their money back here in the last year or so. So it's a market that I think has its place, and I think any large dip is a place to speculate on the upside. I do think that gold's probably overdue for a really good year. We've been kind of bumping up against 2100 for the last 12 years or so. And I think if we test that again, and I think we will, I think we probably break through. And if we do, I'm looking for 2400, 2500. So I think there's definitely some upside. I mean, all the stories that you want to be there for gold to go higher occurred last year, and gold couldn't get out of its own way. But some of those things have resolved itself. We have the US dollar has given back some of its rally. Interest rates have stabilized a little, and interest rates, when interest rates are high, it takes some of the luster out of gold because people that have spare money put it into something that yields dividends or interest, not necessarily gold that doesn't. And so it kind of took away from some of it. And also, you can't deny that Bitcoin probably took some of the thunder out of gold and silver. But those sort of things have all kind of worked themselves out. And so I think now gold and silver finally have their chance. And I do think there's a pretty good chance at a breakout and new highs in those metals. Again, not to buy and hold forever, but if you happen to catch a ride and it goes to, into some of those prices we mentioned, make sure you take some money off the table, because gold and silver have yet to really hold rallies. So be careful.
Exactly. Be careful there for sure.
Yeah.
Yeah. So what about palladium or platinum? Do you ever play any of those other metals?
We don't do a whole lot with those, and I don't follow them nearly as closely as I do gold and silver, simply because the option markets are kind of non-existent. There are non-existent. There are some options listed in some of them, but there's just no liquidity. So like, you can't get in or out, you can't do spreads, and they're kind of expensive. So we really don't do a lot with that. We do work with copper. If you would have asked me 10 years ago, I would have said, never, don't even touch copper, because the option market was just so illiquid, you couldn't get in or out. But that's changed. There's really great market makers. The CME has done a good job at promoting it. So copper options they're not the most liquid by any means, but they're definitely tradable. And so we do dabble in copper a little bit if we're looking for some industrial metals.
Very nice. Well, copper is also highly correlated with the market and the S&P. And you were on, actually, I think, Mad Money last night,
Right.
and your charts were on there, and I love that. I mean, how you correlate and you show how it actually leads by, I think, by 3 months. You showed how when it bottoms, it bottoms 3 months before the S&P. Could you tell us what you're noticing in those charts and what it's telling us about copper and the markets right now?
Right. So copper is basically a bellwether of the economy, or it's considered that. And for whether it is or not, you can't deny the charts. Copper generally, when the stock market's doing really well, if you see copper starting to struggle, it's kind of a red flag. Now, sometimes copper tops out several months or even a year before the stock market. So as far as picking tops, it's not quite as useful in regard to timing. But for bottoms, it's been pretty good. As you mentioned, copper generally finds a low about 3 months before the stock market low. So if copper continues to hold the low that it posted last year, I want to say July 2022, that's probably, I mean, statistically, that's probably a pretty good sign that we've seen the lows in the stock market. That doesn't mean we can't get a big correction and retest like the high 3000s in the S&P, but the overall trend should continue higher in stocks if copper continues to hold those lows. And I personally think it will. I think this isn't necessarily a popular opinion. I do think maybe we're due for a near-term correction in the stock market. We're coming up against some pretty good resistance areas, but beyond just some back and fill and resetting, I think that the stock market has a pretty good trajectory higher. Not because I think the fundamental story is that overwhelming, but everybody's positioned on the short side. I actually just wrote a piece for the street today. In the E-mini S&P futures, speculators are holding the largest net short position ever. And this has been true for a little while, But what some people assumed is as the stock market, like as the S&P 500 was rallying over the last month or so, people were assuming that was short covering, but the reality is specs have actually added to their shorts. So it went up despite shorts being on the wrong side of it. So this is going to be really interesting to see how it resolves itself. And also you could say the same thing about portfolios. Most portfolios are underallocated stocks. And if for some reason it turns out to be a soft landing in the economy and maybe the world's not ending, who knows, maybe all that money comes back in and you could see some melt up regardless of fundamentals.
Exactly. Maybe the world is not ending. I like that.
Maybe.
That's a great one. Excellent points. Last July, I think you said, yeah, last July, copper bottom. So that meant that October was the bottom for the S&P. So then if that holds, then it would be that last October was actually the bottoming of this current market that we're in. And then we could be due for more upside, even though the macro seems to suggest it's the end of the world, and they're very bearish. If you go on those spaces, they're pretty bearish. But besides that, even if the Fed, and it looks like the Fed will be continuing some rate hikes, looking at how tight this labor market is. And the inflation is just entrenched. And we're hanging around that core of high fours, low fives. So, but even with that aside, the chart itself is a great telling. I love that correlation for the bottom with copper and the S&P. So as you've always been saying, only time will tell, and we will see what happens. Regarding commodities overall, is there any particular commodity that you really favor, that you prefer trading, or are you pretty equal across the board, and whatever seems to be working and moving in a direction, or any signals that you catch, you go with that one?
I would say that I really honestly don't favor any particular market over another. I just whatever I do my analysis, and whatever comes out as being high probability, I'm interested in. It doesn't matter if it's soybeans or crude oil or copper or whatever it is. As long as there's a liquid option market, I'm interested. So I don't favor anything, but I do, like I mentioned a little earlier in the podcast, I do think that commodities, like if you look at a weekly chart of a commodity index, like the Goldman Sachs index or the Bloomberg's commodity index, we really commodities have just been completely battered down, and I think we're getting to a point where probably a little too much. As long as the dollar continues lower, which I happen to think it will. I think 107 is probably the upside limit in the dollar index rally. If that continues to be true, commodities, all else being equal, should kind of buoy higher. So just make sure if you're going to participate, make sure you understand the risks, make sure you know the products available. I should point out, a lot of commodity markets offer micro contracts. So people think of commodities as being very risky, and they are, because they're highly speculative. They're not, like I said, they're not buy and hold products. They're not dividend payers. But the exchange has listed some micro contracts that are really small. So they're small enough to where you can get into the market without really having a huge amount of risk and can't sleep at night and that sort of thing. There's a micro gold, there's a micro crude oil. There are mini grains that are very small. So you can get involved in commodities with a very small amount of money and just dabble and see if it's for you. If not, that's fine. It's not for everybody.
Excellent point about the micros. Very important that you're able to come in and play a little bit, but not have to risk too much.
Right.
So that's important to note, micros. And you use the word high probability commodity trading, and that is an important word because that is the name of your last book. And I have to say, your books, I want everyone to know that I read through your reviews and thoroughly impressed. They're called masterpieces. And there are professors who use your options book as the manual to teach college level courses. Very impressive. I think you had John Najarian on your page giving a review saying it's the new Bible of futures trading, and an MBA in trading for the few bucks of a Starbucks coffee. So very impressive books that you've written, and you've written 5 if you include that second edition. So I have to ask you, what was the catalyst for you to not only write one amazing book, but you wrote 4 or 5 of them. Let's just say 5. What was this catalyst that drove you to be inspired to write these books?
Well, I'm in a situation. So as a broker and as an owner of a boutique brokerage service, it's if our clients are educated, our business does better. If people know what they're getting into, they understand the risk, they understand how to manage those risks, our business does better. So that was one motivation. Also, I have a unique uh, perspective because I am a broker. I have talked to a lot of people that are employing various strategies. With some people are trading accounts of $2,000, some people are trading multi-million-dollar accounts and everything in between. So I've literally seen almost everything, the good, the bad, the ugly. I've seen it all. And so I feel like that gives me a perspective to try to organize it and put it all together in a way that can hopefully help people, because I love commodities and I love the industry and I love the opportunities that it provides for hedging and those speculating that are willing to take the risks. But I hate the fact that most people that venture into commodities lose money because it's such a tough arena. And most people just completely underestimate the leverage and they completely overestimate their abilities. And so I hope that my books, at very minimum, can help people avoid some of the heartache in their venture.
That's so nice of you. And I know at your beautiful boutique brokerage, to Carley Trading, you also offer so much free education on trading as well. Very comprehensive site. Love it. Everyone should check it out, to Carley Trading. And I can't wait till you tell us more about the services that you offer. You mentioned the reality of trading, and everywhere I look, it always says you can have big losses, and you always mention that, and that's so important. Now, where do you see the greatest risk coming from with commodities compared to equities? Could you tell us some of the differences
Sure.
from commodities to equities?
Absolutely. So the big thing about the big difference in risk when it comes to commodities versus stocks is most people are not trading stocks on leverage. So whatever they put into their account and whatever stocks they buy, those stocks can go to zero. And to be honest, a lot of them do. Even, I mean, look at WorldCom, like even companies that are big and successful, sometimes their stock goes to zero. So anything can happen. But in commodities, people are generally trading on leverage. What most people don't understand is they don't have to use that leverage. They can remove the leverage by overfunding their account. What I mean by that is, let's say, for example, someone's trading crude oil. Crude oil right now, one contract represents roughly $75,000 worth of oil. If they're trading a full size, if they're trading a mini, it's, well, let's do a micro because that's probably a little more manageable for people. So if people are trading a micro crude oil, they're basically controlling $7,500 worth of oil. So if oil went to zero, they would lose, and they went long it here, they'd basically lose $7,500. So if they funded their account with $7,500, they have no leverage, right? Because if it goes to zero, they're wiped out. But what most people do is they don't do that. The margin on a crude oil future is a micro future is only about $1,000. I'm rounding, but it's actually a little less than that. But we'll say it's $1,000. So if people have a $1,000 account, they go long one micro, oil only has to drop $10 to wipe their account out. It doesn't have to drop 70. That's the leverage, and that's where people get into trouble. Because not only do they use the leverage, but they abuse it. And so that's where people tend to really get into trouble in commodities. And so that's another reason why I wrote the books, is to make sure people understand how that works. It's not unlike, I know that sounds it's confusing to talk about leverage in that way, but it's not unlike people that, they purchase a house, they're only putting 5 or 10% down on their house, but they're making or losing money based on the entire value of that fluctuation. So that's what leverage is. It hypercharges the gains and losses, and it can be hard to manage if you don't understand how it works and if you're overdoing it.
Got it. Thank you for that explanation. That makes a lot of sense. Now, it seems to be correlated with also what the biggest mistake traders make with commodities has to do with margin, correct?
Correct. So they're using too much leverage, which means they're maxing out their margin. So for example, if you have a $10,000 account, I generally advise my clients. Now, some don't listen and they do what they're going to do, but I advise my clients to try to keep their margin to equity 25% or below. So with a $10,000 account, maybe only use 2,000 to 3,000 worth of margin and just leave the rest as your rainy day fund. Some people think that that money is being wasted and it's just sitting there and it's not producing. But the reality is, in commodities, you need that room for error. You need that buffer because maybe Russia does something overnight, maybe China does something. You need that to make sure you survive to continue with your trading. You can't play if you're out of money.
Wow. See, that is very important. Those numbers are like, wow, very different from equities. And,
Right.
you know, you usually don't think that way. And exactly like you said, you're like, I'm just wasting that money. It's just sitting there. Like, what's going on? But that's important with that cushion to give yourself in case, overnight something happens and you need that little cushion or big cushion there.
I would say the risk lies more in the margin than the volatility itself. And I say that because if you think of stocks, like think of GameStop a couple of years ago, think of Nvidia just in the last couple of days, those stocks can really, really, really move. And if you're on the wrong side of it, it can get ugly. Commodities probably aren't even capable of moving quite that fast, but because there's leverage involved, it seems like they're moving even faster. That leverage is really a killer. So that, I think, is what makes commodities risky. That, and on top of human nature, is to get greedy. When a market is going up, nobody wants to sell, right? Because they think it's going to keep going up and up and up and never stop. But commodities always stop. Commodities are basically they're their own worst enemy, because as prices go up, it brings supply, meaning that producers of those commodities see the high prices and then they go into overtime and make sure they bring more commodity to the market to take advantage of those high prices, and then the oversupply pushes prices back down. So it's just a vicious cycle of supply and demand. And if you don't understand that, if you're trading with leverage and you get greedy and don't learn to take your profits when they're there, it can really become pretty hectic. So
absolutely. It's about minimizing those impulsiveness from emotions, because we get emotional and we see, like, you know, remember when oil was 130, people were talking it's going to go to 200. I mean, they were like, it's going to be 180. I mean, it was just, no one ever thought, like you said, would go back to 70. I mean, and we're below that. So it's about that. It's like that euphoria feeling. It's the human nature. It's the emotion, but then at the same time, we need to keep a level head and say it's about supply and demand. And exactly as you just said, how you explain that. And, you know, it's going to come back down. So it's like a cycle that just goes around. So we have the cushion. We need that cushion to protect against that margin and that leverage, that being over leveraged. And then we also want to have that risk management techniques that you utilize, and you're very creative with them, and you talk about it in your book, and you talk about their clever trading strategies, and I love that. I love that wording. Is that the selling the put with the vertical spreads? Are there other types? Are there collars that you use? And I think you have synthetic calls that you use. Could you tell us about something maybe you did recently on a commodity that was a clever trading strategy?
So actually, something that we kind of put out on our newsletter today in somewhat vague detail. Wasn't like a official recommendation, but it was just putting an idea out there. Is with the stock market as high as it is, the S&P or NASDAQ, whatever you're involved in, anybody that wants to hedge their portfolio could consider doing a risk reversal. And what this means is, if let's say that you're, I think we used S&P in our newsletter. So if you're long S&P stocks, a basket of S&P stocks, and you're bullish, but you also are not, you're risk averse and you don't want to be there if all heck breaks loose, you could consider doing, it's kind of like a collar, only it gets complicated because we're talking about assets in two different marketplaces. So you're talking about a basket full of stocks in your portfolio, and then you can use options on futures to hedge that. And what you would do is you would sell a call option. You can sell a September 4,400 call. I'm not making a recommendation officially. I'm just basically for educational purposes. But you could sell that 4,400 call in September. I think it has like 100 days to expiration, something like that. And what you're doing is you're limiting your upside in the S&P to 4,400. So you're giving it some room to move, but you're saying if it goes above 4,400, I'm okay with just giving up those gains, because above 4,400, you're going to be losing on your short call, but you're making it on your portfolio and it just washes each other out. But the purpose of doing that is you use the proceeds from the 4,400 call to buy I think it was a 3,875 put or a 3,900 put, somewhere in there. So basically right below support levels. And you can do this for free. So the money that you collect for the call pays fully for the put. It's free insurance. The only thing that it's costing you, aside from a couple commissions, is you're giving up gains above 4,400. So that's a strategy that I think is kind of creative, and it actually is kind of a win-win, because you're getting protection without paying for it. Some people will tell you just always buy puts in your portfolio, just in case something happens. But the reality is, if you did that, like if you bought puts every 3 months, every quarterly expiration, and just kept doing that to make sure you have insurance in place, you're going to basically spend all the money that you made on your portfolio, you're going to spend in insurance. So if you do it this way, you're not spending anything on your insurance, and that way, aside from giving up a little bit of upside, you have a floor in your portfolio. Now, that type of strategy does not make sense when the market's in a hole. So when the S&P was at 3,500, 3,600, you absolutely would not want to do that. But with it up at 4,200, it makes sense, because yes, we might go up in the next 100 days, but we're probably not going to go up much further than 44. Maybe we will, and if we do, then that's the risk you take. But if it does take a dive and we break support at 3,900, you're protected 100%.
Love that. Love that. Not having to pay for downside protection is the dream. And that's great. And, you have to know what type of market you're in, or at least be familiar with the way to use these options. And, I think we've been in a sideways grind for a little while. I mean, a lot of people were saying, oh, it's like we're right where we were back in March. It's like we're just in this sideways market. And so, I mean, I've been using sometimes iron condors and, other types of credit spreads. And it's always nice to get credits, get premium, and, you want them to expire worthless, of course. And, that's the ideal way. And having, free downside protection. Love it. I mean, that's very creative.
Yeah.
Thank you for sharing that. So, you debunk some of these axioms that people say. The trend is your friend. And I saw that you had, the trend is not always your friend. Could you tell us about that, please?
Well, I mean, there's a second part to that, and it's the trend is your friend until it ends, and then it's not. So it's been my experience. Now, I'm not in stocks, the world of stocks, this is probably different. But in the world of commodities, we already talked about how bull markets are generally temporary in stocks.
Mm-hmm.
So trend trading in commodities can be really, really difficult. Now, it works occasionally. Like the last couple of years, it actually has probably worked. It's worked really well the last couple of years, because we've had some runaway markets in the grains and in the energies. So occasionally it works really well in commodities, but for the most part, trend trading is really a huge struggle in commodities. And the reason being, most trend trading systems have very slow signals because they're waiting for confirmation of the trend. And once that trend is actually confirmed based on some of the slower signals, usually that trend is ending in commodities. Again, not for stocks, but commodities, this is true.
Commodities, yeah.
Yeah. And so I've seen so many trend traders just suffer really, really giant drawdowns for years before the strategy pays off, because at some point that, usually when the trend is just starting to confirm itself, it rolls over and markets take the escalator up and the elevator down. So it's a tough game.
Yes, excellent point there. That's one of the many differences, like we're discussing, between commodities trading and equities trading. And this trend that ends is very significant in the commodities market. So that's one of the many differences, and that's the clear distinction there. How do you analyze the commodities market? How do you view it? I saw that you do a combination of technical, fundamental, sentiment, seasonality. That sounds like a lot, right? Do you just look at all these different factors and come up with your own thesis? Or are there certain signals? Like, what do you look for with telling you different signals in the commodities market?
Well, I mean, the bad news is I'm getting old. I'm in my mid 40s, but the good news
You're
is
not that old.
because I'm that old, I've been watching the markets for a long, long time. So I've picked up on some things. Now, markets are always changing. So sometimes lessons that I learned, earlier in my career, no longer even, they just simply, it doesn't matter anymore. Things have changed. Everything's gone electronic. There's algos. So it's a continuous process, but there are some things that generally have just continually work more than they don't. And that's in commodities, that's seasonality. Like certain commodities do behave certain ways, certain times of year. Now, the last 2 or 3 years seasonals have not been that reliable, just simply because we have all these weird things going on. But I believe that's probably temporary and we'll go back to a more normal environment. One thing that I for sure has just never failed is commitment of traders report. Basically, in a nutshell, it's not something I can explain fully, but the idea is we look for overcrowded trades in the commitment of traders report. That's a report that's issued by the CFTC. It's the Commodity Futures Trading Commission. It tells us if traders are, well, speculators specifically, are basically in overcrowded trades or not, and what they're doing. And usually when you see an overcrowded trade, like we're seeing in the S&P right now, where everybody's short, we saw it in oil last year, everybody was long. It comes to a point where it doesn't matter how bullish or bearish the fundamentals are. If everybody's already expressed their opinion in the market, they've already done what they needed to do, the market just runs out of buyers or sellers, whichever the overcrowded trade is. And at some point it whips back around. And when those speculators that are all on one side of the boat liquidate, it can come back really, really hard and fast in everybody's face. So we've learned at very minimum to not be in the herd when that comes around, and hopefully we can even catch the other side sometimes.
Absolutely, avoid the herd. I think that works in all markets. But when you said the word normal, we get back to a more normal market. What do you mean by normal, and what is a normal market to you?
I think we are in the process of normalizing. And when I say normal, what I mean is lower volatility, more predictable markets. Now, markets are never predictable. I'm not saying they are, but I think it's fair to say that since 2020, predictability has just been out the door, right? I mean, for example, the US economy was mostly shut down in 2020, and the stock market had one of its best years ever. I mean, who could have? Not many people could have predicted something like that. Not many people could have predicted oil going to 130 prior to the Russian invasion. So there's a lot of things that are just simply wild cards that we're probably not going to get a series of wild events like COVID and war and things like that just continually keep pumping volatility into the markets. I think we probably get back to more 2017, 2018 volatility, boring, nothing going on. And as a broker, I will welcome that with open arms. I'm tired. It's been a rough couple of years.
Yeah, it's been tiring. I agree with you. It's been a lot of ups and downs, and it's been very volatile, and not knowing where it's going next. And I think, like you said, there's a lot of people go short the market. So because of that, it seems like it's staying up even longer. And even though the fundamentals, everyone talks about the market. I mean, I even also say the market's overpriced. I think it's very pricey. I think it's about 18 times earnings right now. And with the risk-free rate being in the 5s, it's why take on risk, unless you get a lower price. But hey, if everyone's shorting the market, what's going to happen? It's going to go up probably. So excellent points there. I'd like to ask you, I know you started back in 2004, and now it's almost 20 years you've been trading commodities, and that's right. That's amazing. So I'd like to just know the transformation of the commodities trade. Is it just been you said it's changed because of many different factors in the
Mhm.
technology, but are you noticing that it's still remaining cyclical as it's been, and the similar cycles take place? And what's changed over the years, or what's remained the same?
I would say the general cycles, although the last couple of years that hasn't necessarily been true, but in the big picture, they've kind of remained the same. So there's definitely, the thing about commodities is things change, but also they don't. High prices always bring low prices. They always correct themselves. It just is what it is. Even though every time we see some wild commodity rally, everybody says this time is different. It never is, because most commodities are renewable and we just simply grow more or make more, and producers have an incentive to do that at higher prices. So that's probably never going to change. And also we have to note that as time goes on, technology gets better and we get better and better at growing things and making things. And so that keeps pressure on commodity prices as well. One thing that I will point out that's changed a lot since I first started is when I first started, we had day sessions. The markets would close, we'd go home at night, and we really wouldn't think about what's going, we asset prices were probably moving, but we couldn't see it moving on a screen, so we just didn't think about it. And then we'd have to wait till the next day to adjust anything or trade anything or do anything. In today's world, commodities trade basically 23 hours a day. I mean, it just never stops. Opens on Sunday night, and I mean, it closes for an hour every afternoons for the exchange to reset their computers or do what they need to do. But basically, it's trading around the clock from Sunday night to Friday afternoon. And so there are some advantages to this because you can react to things at any time of the day, and there's pretty good liquidity most of the time. But the downside of that is even with decent liquidity in the overnight session, it's not nearly as liquid as it is in the day session. So what you get is big orders, like for example, brokerages liquidating margin calls or algos jumping on a position knowing that they can push the market around a little with a big order. So there's all kinds of things that are like, I don't want to say manipulating, but that's probably the best word for it. Prices in the overnight session. And I've noticed a lot of the volatility comes in the overnight session. And unfortunately, a lot of the smaller commodity speculators end up running out of money overnight because you can't wire money, right? If you're on a margin call, you can't wire money till the next day when the bank's open. So sometimes those overnight fluctuations, sometimes they're temporary, but they wipe people out. And then the next day they're as if it never happened, which is really hard to watch. So while there are some advantages to 24-hour trading, I'm actually in the camp of thinking I wish it would go back to the early 2000s where we actually closed and then had to deal with things in a short amount of time and let it all be, in the liquid day session.
Absolutely. Wow, that sounds scary overnight to be wiped out like that. But
It is.
yeah, I think less is more, and maybe
Right.
more moderation with that would be best. You mentioned the US dollar, and most people know that US dollar tends to be inversely related to commodities. So as the dollar goes up, commodities goes down, and vice versa. Not always, but usually works that way. Do you keep a close watch on the dollar as a commodities trader?
Absolutely. That's one of the first things I look at every day when I wake up. Um, the last couple of years have really thrown a wrench in that inverse correlation with the dollar and commodities. I think it
Yes.
will come back as things normalize, assuming they do. There's just been too many interferences. I mean, we've had central bankers interfering with markets and trying to control business cycles, and all of those things have worked against some of the normal relationships that we would normally observe. But I think as time goes on and the dollar comes back down to a more realistic level, I think that those correlations come back. And if anybody that's following commodities are really cheap at the moment versus where the dollar is. And what I mean by that is commodities as the dollar has been retreating from the dollar index got to 114, now it's at like 105-ish, and it was a little bit lower. As the dollar's retreated, in a normal world, that would have helped keep a floor under commodities. And maybe it has. Maybe without that move in the dollar, commodities would be a lot cheaper than they are even now. But I don't think that's true. I think for whatever reason, the commodity market's been kind of ignoring the currency market. But at some point, that's going to change and it'll all come back into line. And either that means commodities have to come higher, the dollar higher, or maybe a little bit of both.
Great points there. Speaking of the dollar currencies, I have to mention a potential alternative currency, and I think you mentioned it earlier, Bitcoin. Do you watch the Bitcoin market? Are you into Bitcoin? Are you bullish on it or anything like that? Do you have any thoughts on it?
I try not to think about it. I have some clients that trade it, and I'll kind of give them some advice, just pure chart work, because honestly, I have a hard time grasping the whole fundamental idea of Bitcoin. I appreciate the technology, and I think that the technology is probably going to be with us for a long time. But the value of that specific asset, I have a hard time finding any intrinsic value in it. And I know some people have completely opposite opinions. Chart wise, to me, it looks like probably a ceiling around 32,000. I've said this in previous interviews, and I've gotten a lot of flack for it, but I still think it's probably the most likely scenario. I think Bitcoin probably makes its way below 10,000, maybe somewhere around 8,000. If you look at a really long-term trend line, that's pretty much where it comes in. Now, maybe I'm wrong, but that's my thought.
I love that. I just want you to know, first of all, I'm so honored to have you on the Row Show. You're awesome, Carley. I just want to stop and take a break for a second to say you're really awesome. I admire you. You're really,
thank you.
You're really good. I mean, commodities trading is a complex, that derivatives market is, to many people, it's so foreign, and you really make it seem so easy, and so great to have you here. And I love your honesty, and that's the key, is transparency and honesty. And that's what this show is about. It's all about it. I mean, it's independent, and I welcome all your opinions. And I love that you mentioned that, because that's a great point. That it could go, anything's possible, and it could go up to 10. And hey, I'd be a buyer all over that one, because
I don't blame you.
Yeah, I mean, that sounds great. I love the inelastic supply of Bitcoin at 21 million. We have a debasement of currency, of fiat currency. Right. So, and that's the argument that I see there, and as an alternative, asset. So just another thing for diversification of portfolio allocation. But great points there. I love it. I love your chart analysis and everything. I want to talk about your mindset, because the volatility, the leveraging, and the overnight, major swings in commodities trading. How do you maintain this positive mindset that you're able to just stay the course and just be really resilient and just empowered? Just very impressive.
Well, thank you. I appreciate all that. I mean, the reality is I've been doing this so long, I'm basically dead inside. I don't feel anything anymore. So earlier in my career, trust me, I was a hot mess, but now I'm just like, you know what? It is what it is. I haven't seen it all, and the last couple of years have proven that to me. I'll never be able to say I've seen it all, but I've seen a lot. And at this point, you just kind of learn, you roll with the punches, and you got to just nobody's perfect. I make mistakes, and but we all do, and you survive, and you get up, and you keep going. That's just what you do.
You have the demeanor of like an ER doctor. You're like one of those that like first call or something, like once it right in there, because you just have that calmness, and you have a wealth of information, and it's just amazing. I just love that. I guess it's from years of just battle wounds, right? Of just like getting, seeing it all and being there and experiencing it. And that's why I always say, it's about experience, and that's key. It's expertise-based, intuitive decision-making, and that's absolutely what you're doing day to day. And that's why mentoring is so important. And I want to know more about Carley Trading and how people can mimic your trading and learn from you directly.
So Carley Trading is basically a boutique futures and options brokerage. We only offer futures and options. We don't do stocks, bonds, anything like that. It's just those products. And you can actually, if you go to our website, decarleytrading.com, you can, there's quite a few educational articles and videos, but the best part is you can sign up for a free trial of our newsletters, and we'll send you multiple newsletters a week, market commentary, trading ideas, that sort of thing. They're intended to be educational, so it's kind of a learn as you go process. Our brokerage clients receive those newsletters free of charge, but again, you can sign up for a free trial. You can also follow us on social media. My handle on Twitter is @CarleyGarner. I try to post charts and commentary and tidbits here. I do post dog pictures, so if you're not an animal lover, beware. But
I love that.
I'll try. Yeah, I try
She's
to
the
keep
cutest
it spicy.
beagle. I love that. And now your brokerage, you actually have the futures trading. We could trade the commodities and all that, correct?
Right. So anything that's listed on the U.S. futures exchanges, so the CME Group or the ICE exchange, you can trade with us, and even some of the overseas products, if they're mainstream overseas products, we have them as well. So absolutely.
Wow, because that's very difficult to find. I know
Yeah.
that it's not every brokerage that offers all those different features. And you also hold everyone's hand as well with the educational training, right?
That's correct. So we offer, just to clarify, we offer everything from full service to discount online. So just because most people assume we only offer full service, and that's not true. Most of our clients actually trade online. We set them up with platforms and they do their own thing. But the reason they like to trade with us as opposed to some of the bigger shops is a couple of reasons. Because we only offer futures and options on futures, it's streamlined. We're probably a little better equipped to manage that sort of business. We can provide lower margins, better service, quicker service. We answer our phones, which not everybody does. We answer our emails. So we just make sure that everything's running smoothly for everybody, in addition to giving them trading ideas and market commentary. And of course, if they have questions and want to bounce an idea off us, that's what we do as well. So
I love that. That is boutique. I see your phone number on there. I was like, I think it's 702 or something. I was like, wow, she has her phone number on there. Very impressive. I love that. True boutique service. Now, one last question just to end our amazing video podcast today. What commodities are you most bullish on for the next, I'll give a time period, maybe the second half of this year? I don't know if that's too long of a time period, in the next 3 months. And which are you bearish on, if any, for this 23?
I'm going to say I'm most bullish on crude oil, so energies, crude oil and natural gas. I've been that way for a while, and they haven't been able to do a whole lot on the upside, but I think they will. Also, as far as being bearish, I'm not sure I'm really bearish any commodity. Maybe sugar, but nobody follows sugar. Honestly, I think commodities are in the hole. I think being on the long side is probably the best side.
Wow, there you have it. Carley Garner, thank you so much.
Thank you.
And Carley Trading, make sure to check out that website. Sounds like you have a fantastic boutique brokerage there.
Thank you.
Thank you so much for spending time with us and sharing commodities trading. It's truly a specialized type of trading, much different than the equities market. So thank you so much for taking the time today.
Thank you for having me. It was fun.
Thank you. Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon. All investment, real estate, financial, legal, and tax opinions expressed by Rosanna Prestia or on The Rose Show should not be relied upon as professional advice and are intended to be used for informational purposes only.